This is the process. I'm Kirby. Y'all know how that goes. Just fine tuning some things here to make sure I'm good to go, good to snuff. All right, good to go. All right, let's get to chopping this fable. I'll wait and I'll start talking while people join in. Again, like always, please let me zoom in a little bit on me, get my fat face in there. But as always, like, subscribe, share with all your friends, families, and other ones out there, and ask the questions in the comment section. I love answering questions that's out there. It's a lot of things going on. Government shutdown is over. That's a good thing. That's a very good thing. The government shutdown is over. We got that out the way. But it's some other problems going along with that. Air traffic controllers, we still got a shortage there on air traffic controllers. Hey, CN, how's it going? We still got an issue with air traffic controllers, just a number of them, period. We've been talking about it for many years now on this channel about how the jobs of today are not the jobs that will be here tomorrow. We talked about stagflation. We talked about automation. We talked about AI. We were talking about this years ago before it became in vogue on the regular, national media scale. And, going back to the crux of the foundation of what built this country to make it a superpower back in the day, a lot of those workers are leaving the workforce. And it's up to younger generations, hell, I even say my generation and younger generations, to fill that gap, because that's where the money is. AI and automation is eliminating all of the other the jobs that the boomers told their kids and their grandkids to do: go to school and sit in the office and things like that. Keep it simple. Hey, how's it going? But so that is the void there. I mean, literally, the office jobs are paying way less than it used to pay back in the day, comparison to cost of living and things now. And the big money is being made in the trades or things like air traffic controlling and things like that. So for people, if you're traveling this weekend or you're traveling the next week or so, it may still be delays. And the delays is not the government shutdown. The delays is they don't have enough personnel to even air traffic control. On average, an air traffic controller works 12 to 14 hours a day. On average. So, of course, it's skewed. Some work way more, but ain't nobody working less than 8 because of the shortage of workers. So it will probably be more cancellations going until the next week. I know Thanksgiving and holidays are coming up, so just be cognizant of that. Be patient. And I'm saying being patient because of who's in office or whatever. Just be patient because you really don't have no choice if you want to get to where you want to go. So don't be that person in the airport that's on the next TikTok video going viral. That's all I'm really saying about that. What else is going on out there? Berkshire Hathaway, they just announced a stake in Google, or I'm just gonna say Google. I ain't about to sit here and say all these damn fancy terms. They just announced a stake in Google. If people that know Warren Buffett, they have not ever, that's not a sentence, I'm not gonna say that. Warren Buffett and Berkshire Hathaway, they're not very into, that's what I'll say, they're not very into the technology space. The first real jump into the technology space they went was Apple. And then now they've cut lion's share of their Apple holdings, and then now they're going into Google. Google, excuse me. Going into Google. So they purchased a big stake in that. So that's a news headline, just because Warren Buffett always say you never invest things that's outside your competency. So Warren Buffett, of course, he's worth maybe 150, 160 billion dollars now. But if he would have had the understanding of the technology space years ago, he would probably be a trillionaire before Elon Musk if he understood the technology space. But he's getting into it, I'm not going to say late, but he's getting into it later in life than if when he had the capital, he could have got in and took a gamble on it, because that's what it would have been, a gamble, because he didn't understand it. So that's going on in the news also. I'm just hitting some of the topics that's going on in the news. And And only reason why I brought up the Berkshire Hathaway investment is a lot of people that have 401ks. There's a lot of people that got Roth IRAs. It's a lot of people that got, different investment vehicles that they don't even know about that Google and Berkshire Hathaway is in. So that right there affects your money. On the tariff front, Donald Trump has been feeling some pressure. He's feeling some pressure. Of course, he pushed his campaign on the grocery prices, and the cost of living is getting higher and higher in the United States under the Biden administration, and that was one of the reasons why, everybody should elect him instead of Kamala Harris. He did get the egg prices down. He did get the gas prices down, but everything else kept going up. But Friday night after the market closed, coincidentally after the market closed, Trump put cuts to tariffs of goods like coffees, bananas, beef. Beef is a big issue. I'm not gonna lie. This weekend or last week, I went to the grocery store to pick up ribeyes. I saw the ribeyes. Once I saw the price, I just pivoted. I don't give a damn if I got $3 or $5 trillion. I ain't paying that much for ribeyes just for the sake of buying some ribeyes. But yeah, so he cut the cost on beef and slashed a lot of produce costs on the tariffs. He slashed the tariff costs for a lot of countries that import that stuff. Will it help? We'll see. That's all I'm saying. We'll see. Of course, people that's been following the channel, they know I was a fan of the tariffs. Do I believe that the tariffs is the reason why the costs are going up? Somewhat, but I believe greed in corporate America is another part of it also. And again, I am not I'm not against capitalism. I'm not one of those people that say tax to 1%. But I know greed is greed. And let's see what else we got going on here. I'm just going down the scroll. I got a list of things that I could talk about. For all you YouTube TV subscribers, Google and Disney reached a deal, so now you get ABC and ESPN back on your service provided if that's the thing that you're into. Just want to hit everything. The CEO of Walmart is stepping down. Will it take a small hit to the stock? Maybe, but I think Walmart in general, because of their organizational setup, that they will be perfectly fine where they're at, no matter who they put at the CEO. Now, if somebody go do something drastically crazy, then that's one thing, but I believe the moat of Walmart itself will still be fine, even if they put me as CEO and try to figure it out. I don't know what the hell I'm doing, but I believe just with all of the stop gaps that they have as an organization, that I will be successful by a mistake because they have good governance over what they're doing. What else we got? All right, as far as the market, I usually save this for later, but I'll say it now because I just want to get into the subject topic at hand. The market's been pretty funky, and if you've been watching this channel on Saturdays and again, before I get there, for people, ask the questions in the comment section. Trust me, I will get to every comment in the comment section. I do not leave comments left behind. But for the people that's been following this channel for a while, I believe about 6 weeks ago, because we do these lives every Saturday, about 6 weeks ago, I said I believe the market is very frothy. I believe 3 weeks ago, hey, how's it going, Marcus? I believe the market is very frothy. And then I believe 3 weeks ago, I said I started trimming the contributions that I had on 401ks, Roth IRAs, and things like that, just to get that number down on how much I was investing, because I just believe that the market in general was overpriced. Not individual stocks, but the market in general was overpriced. I didn't completely stop putting money in the market. I just trimmed the position. So let's say if I was 100% in the market 6 weeks ago, and then I trimmed it, now I'm down to 50% of my allocation that I wanted to put it into the market. That's where I'm at now. And then so the market, ever since we had that conversation 3 weeks ago, and I'm just looking at the SPY, or I could look at the QQQs because it has more volatility and variance in there, we've got interesting things going on. So we hit the high of 689.7 on 1028. That was roughly around the time I said I was cutting my position in half on all my long-term investments. And then we came down, we tried to go ahead and we came down to around the 662 level. And then we tried to make a rally to get back above that 689 level on the SPY. And the SPY, for the people that don't know, is the S&P 500 just in ETF format. That's all it is. I mean, it's no different than the S&P 500. And then we had a rollover situation the rest of the week after we tried to take back that 689.7. We got up to 685, and then we rolled back over, especially last Thursday. It was a brutal event for people that's in the market. That's where we at. And then now we sitting there, the 8-day might cross below the 21-day on the daily on the S&P 500. So we can get some more volatility that's going on in the market. And that was one of the things that made me say, hey, I probably need a cut position. And we talked about how the price to earning ratio for the S&P 500 historically has been 18 times earnings. For the people that don't know, that just means the price is divided by 18. That's how much the companies in the S&P 500 has earned. It's usually 18 times earnings. We're at currently, at the time of the video 3 weeks ago, we're at 30 times earnings. 30 times future earnings. And that's not a good number historically. And then that's what made me cut the amount that I was contributing. I don't ever 100% go zero into the market. I never do that. So I cut it back 50%. And then we've been getting this crazy volatility that's been going on. And now we got to see where it goes. And then that's why you see Trump scrambling right there with the tariff cuts and what have you. But we don't know exactly where it's going just yet. Only thing I tell people, like I tell people on this channel, I tell people when I talk to them in person. Hey, Levita, how's it going? When I talk to them in person, it's find a benchmark. You see where the high of the market is. Because no matter if you on Webull, no matter if you on Robinhood, Charles Schwab, Fidelity, no matter what. If you pull up a chart of the S&P 500 or SPY, it'll give you what the high is if you pull up a daily chart. The high right now is 689.70 cents if we want to go that deep into it. And then the only thing you do from there is put minus 5%, minus 10%, minus 20%, minus 25%, and see what those price levels are. And then what I would do is when it drops 5%, let's just say, and I'm just using a small number, but of course you can scale it to your way of life. Let's say you have $500 of its discretionary income. Again, multiply it to your life of how much discretionary income you have to invest. So I do those measurements, 5% down from the high, 10% down from the high, 15, 20, 25% down from the high. So I got $500. I put $500 in my investment account. When I see it drop to 5%, I put $100 in a month, and I'm consistently putting it in there a month, long as it stay below 5%. If it's only below 5%, then it go below 10%, then I might put 200, 250. It goes below 20%, then I'm putting 300, 350. And then if it goes below 20, 25%, then I'm putting the whole 500. But I'm still consistently putting the 500 in the account. It's just the amount that I'm investing at that time will get bigger as the market goes down. It don't get smaller, it gets bigger. And then once you get to that 20, 25% drop range, then I'm putting the whole 500 down. And I'm going to keep putting it in there every month until it is 10% above the previous high. So right now it's 689. If I can get a 20% drop, I'm going to go full 100% back in, and I'm not taking off that full 100% until it get at least 10% higher than 689.7 on the SPY. I won't do it. And if you look at the charts, you've seen why. I seen the market was frothy, shaky, fidgety, and I start cutting allocation. That's why. And then that's all you gotta do. And then once you get 10% higher, you just keep investing where you at, where you at, where you at. You might see the market go up. Don't think about, oh, I made a loss something, or oh, I missed out on something. Because we get into a frothy period, you might get a rollover. But if you don't get a rollover and keep going, you still got money invested. But if you get a rollover and then you're not used to the stomach churns of that much money falling down or going down when the market roll over, then you got a problem. So that's what I'm saying. Always understand just the price levels of the market, and it will help you in the long term. But there is no like, I was about to say there's no right or wrong, but I'd be lying. But there's no wrong if you just go full fledged. Once you get down to 20% and you just keep putting your $500 in there every month, no matter what, you don't care where the market's at, then you're good. I'm just trying to get you to avoid some of the headache of putting $500 in a month when you're at the all-time high and then it roll over for another 10, 20, 30%. And then now you got to sit there and look at a portfolio that's red for a long time. That's all I'm doing. But you're not wrong if you dollar cost average and you just keep putting it in, or you just go full fledged and just keep putting it in there month after month after month, and then you just dollar cost average that way. So there is no wrong answer to this. The only wrong answer to this is if you don't invest at all and think that pension funds, mom and them, your kids gonna be a pro athlete, or you think that the government's gonna just drop a big money bag out the sky and pay for you to get there. All right, so that's what's going on. As far as the trades that I got going on, y'all know I went retarded. You don't supposed to say that. I went crazy. That's what I meant to say. I went crazy on the SoFi options, especially when it went down. I just doubled up and padded my stats on. I padded my contracts on the SPY trade. Fiserv, after that earnings disappointment, even with the big dramatic drop, it dropped 50% before that, and it dropped another 50%. I still think it's overdone, so I'm still playing the leaps on that, and those leaps are in January. SoFi, I'm still holding up. I still got the June 26 calls on that, but now I'm gonna be honest, I have way more contracts than I ever thought I have in that situation. Oscar, I'm still playing that. I did cut off my target play, my target leaps, not because I thought it was a bad trade. I just needed more capital to buy more SoFi. And then, and I think I still have more time in target. I can go pick up those shares also, and we'll see how that plays out. So for the people that's still in target, if you decide to follow the trade, don't think I abandoned it. Just I was running out of capital to keep funding my infatuation with these SoFi options that I have way too many of. What else going out there? So that's just on the trade front, money front. But yeah, we did see some crazy moves in the market. We saw some ups and downs. We saw crypto on. So for crypto altogether, I've been a buyer. I've been a net buyer for the past weekend. Well, I've been a net buyer for the past month on Bitcoin since it dropped down from the 120 level. But I got more aggressive when Bitcoin dropped sub 100. Now we can call it 96, even though it's at 95.8. 96, I'm still a buyer there. Ether, I've started getting aggressive, sub 4,000. Now we at 41 or 4,200 on there. And then XRP, the Solana, Dogecoin, I don't venture in that space. But XRP, under 250. I picked up some, but I haven't been super aggressive in that realm because my cost average is, I think it's like at 218. I believe that's where it's at. So I wanted to drop down more. And then for all of those coins, I'm okay with them dropping down more. And then again, it's keep buying. I'm not sitting here saying, oh, woe is me because the prices are going down. I want to use the money that I bring in to buy assets. And yeah, I believe cryptocurrency is a form of asset. Now, do I believe it should be 100% of your asset base? No, I believe that it should be 5% of your net worth base. But that's just what I believe. Whatever you want to do, That's what you want to do. But my belief is it should be 5% or less of your net worth base. And what it comes to that is simple. If we are totally 100% wrong on this cryptocurrency thing, and when I say we, I mean everybody in the crypto space. If we're 100% wrong and it all goes to zero, you still have 95% of your net worth. But if the people that's in the crypto space is 100% right, that 5% of your net worth, if it takes off like everybody promised it to be, Bitcoin $1 million a coin, Ethereum 500,000 a coin, XRP $100 a coin, the 5% invested will supersede the other 95% of your portfolio. So it's really just about risk reward. Or as the kids say, 6-7, 6-7. But that's what it is, risk reward right there. That's how I look at it. I'm not going to sit here and tell you, oh, I'm a savant. I know everything about crypto. I don't. But I'm willing to lose up to 5% of my net worth on, some people call it a gamble, to supersede the other 95% of my portfolio. That's how I look at it. So, I mean, I will never tell you to go more than 5%. I don't believe I'll ever tell you to go more than 5%. And I believe there's other asset classes out there that will give you a more stable feeling about yourself, a more stable understanding, a more stable hands-on physical asset, physical tool than what you see right there with Ethereum, Bitcoin, and XRP. And let's be honest, there's no intrinsic value in Bitcoin. There's really no intrinsic value, I believe. Ethereum, their intrinsic value is the platforms and the other things that can offset on there. And same thing with XRP, as far as payment systems, that's their intrinsic value. But I can't value these coins like it's a regular S&P 500 company. So, sorry if people out there crypto bulls and think that you should go all in on it. I just don't. Because there's other things out there that you can grow your net worth pretty significantly without taking on all that risk and not knowing the unknowns that is in that market. Let's see what we got out here. I thought that, Levita said, I thought that as long as you put your years in a company, all the years that you put in with a company, that you will get a pension. Yeah. So for people that has, grandparents that still living, that worked in, the big three and worked in these big corporations, 60s, 70s, 80s, 90s, early 2000s. And, they had, the 401k, they had the pensions and things like that. Those things are gone for the newer generations. Anybody that's working past like 2000, the last company that I knew that was doing a pension, I think they stopped it in 2017. So, I mean, forgive me for my ignorance if y'all have some companies that still pay pensions. I'm not talking about 401ks, I'm talking about pensions. Was 2017. Even the U.S. military, instead of giving you 50% at retirement, now it's 40% or 35% or some fuzzy math there, and then you have to put the rest in a 401k type investment to get to 50% at retirement there. But the retirement game, the pension game has gone out the window. I'm going to take it a step further. The retirement game has gone out the window if you're solely dependent on a job to retire. Now, it's some people in the military that's grandfathered in that will get, 50% of their income, and then they will get, hopefully 100% disability or whatever, that could probably, retire comfortably. I mean, of course, they ain't living lavish and things like that, but they can, take care of the necessities and have a little bit of extra left over for the ripple on the weekend, and they'll be fine. But for the regular layman, the regular everyday person, the pension fund is gone. You got police officers and firefighters out there. They still in those unions that still offer that. But that's in, the the public sector, but in the private sector, they try to eliminate that as fast as they can get rid of it. Because the true reality is these companies, even though well-intentioned as they were, even back in the 50s, 60s, 70s, and even 80s, 90s, to provide a pension for their employees, the true realities is these companies weren't good stewards of money. And what I mean by good stewards of money, they wasn't collecting the money that you put in, the money that they was contributing to the pension, and doing it in good faith, putting it in the best possible position for the employees to win. A lot of companies that's paying pensions now to the boomers and so forth, they're using the funds that come from the people that's working today to pay for those funds. Y'all know I was, born and raised in Detroit. The city of Detroit went bankrupt because of their pension funds. So if the city of Detroit pension funds, if it was all Gucci, you put your money in, the city put their money in, and they put it in a good vehicle that would produce income for you for the rest of your life, the pension fund wouldn't be a liability on the balance sheet that made them go bankrupt. A pension fund is a liability on companies' balance sheets. That's a problem. If you look at Ford, you look at GM, the pension is a liability. It's a liability because they have to pay that, they have to pay that money out, and they necessarily don't have that money sitting in an account ready to pay out. So I know these companies, they Fortune 500 companies, they're supposed to have the smartest brains in the world. They should be investing our money in the right places. They're not. I know you probably heard of hedge funds and you thinking that, hedge funds, they the smartest investors. Do you know 90% of hedge funds don't even beat the S&P 500? They're just putting your money there. So if you believe these Fortune 500 companies got the smartest people, and let's say these smartest people are hedge funds, you're not even beating the S&P 500, but they gambling, doing something else with the money. They probably got a long short position on. They probably, of course, these hedge funds, if pension funds are using these, are, charging them probably 20 and 5. That is how this thing works. So the companies itself is not good stewards of money. So if you work for a company and then that company happens to go defunct, and then your retirement age or your pension age is coming up, it's a likelihood that they won't have the money there for you. Now you can go sue and spend all your money on lawyers to try to get some money that not there. It's like trying to get blood out of a rock. But if the company has went defunct, the pension fund has went defunct, unions went defunct, where's the money gonna come from? The government is not going to sit there and give you an extra paycheck to say, oh yeah, you worked for 20 years in the 60s to the 80s. I'm going to give you an extra paycheck because you're supposed to got pension. That's not how it works. I wish it did, but that's not how it works. So, who else is out there? Okay, I seen that there. All right, so anyway, I'm just going to leave it right there. I went 30 minutes in. I was going to talk about all money and all money ain't good money and all that other stuff. But the true reality of it is, and I'm gonna cut my part of it short, is do what makes sense. And what I mean by make sense is, for the life of me, I see people make decisions financially that will be the detriment for them forever. I see people hold on to real estate. People have a job that don't pay as much, but just because they want to live in a certain area because their standards are high, they sit there and suffer just to say, I want to live there. I seen people chase the money and didn't factor in the real cost of life. And what I mean by that is I've literally seen people who live comfortably in one area of the nation, and then because they was paying them more money in another area of the nation, maybe double the money that they was paying them in another area of the nation, they ran and left that area. and went to the higher paying job. But they didn't factor in the 3 times cost that it went up. So I haven't seen people go from being comfortable to struggling, even though they have a higher paying job, just for the sake of saying that they have the money. It's more, I was going to say it's more to life than money, but it's more factors that go into it than just, oh yeah, they're paying me more. But it's all about the net of it. People, trust me, you don't go to work for the money. I know it sounds crazy that I'm saying it. You don't go to work for the money. You don't go to work to go on vacation. You don't go to work to go to the club on a weekend. The only reason and the mandatory reason why you wake up every day, no matter if you like it, love it, or hate it, why you go to work is to pay the bills that you have. That's it. You don't go into the HR office saying, hey, I need a pay raise because, oh, I need more money so I can club, or I need more money so I can take more vacations. You go ask for a pay raise because, oh, the cost of living is higher. Oh, the electricity bill went up. Oh, the rent payment went up. That's the reason why you go to work. But the reason why you go to work is not because of a necessity per se. No, it's a necessity. You got to pay the bills. But if you look at exactly what you needed to survive compared to where you work and the stress that you put yourself through, you would look at life a little different. But it's rarely you go to work and see somebody that's there that don't need the money at all. You go to work because you decided, hey, I want the new car. I want the fancy apartment. I want some buy now, pay later. Now you got to pay it all back. That's why. Because of the wants that you made. I talk to people all the time and I say, why are you so in a rush to buy a single family home when you can go buy a duplex? Oh no, I don't want to do that. So that means you want to go get a job and work forever. That's all it means. Because it's so many ways to make money, but it's way more ways to destroy and lose money. But we destroy and lose money because of the wants that we have, not because of necessities. And then we fake like, oh, it's necessities. That's the reason why I'm broke. Oh, it's the kids. You decide to have those kids. Kids are a want. They're not a need. Just FYI. Everything, all the clothes, the shoes, the Jordans, I don't even know what the new style is today, but the Jordans, I was about to say Fila's, and then y'all can laugh at me. But the Jordans and all the high-end stuff that y'all put y'all kids in, that's your wants. 90% of the time, it ain't even they wants. You prescribe them to live this lifestyle, and then in inverse, you prescribe them to want the things that you put in their life that they got to go get higher paying jobs to afford to maintain the lifestyle that you wanted them to have. And then you wonder why y'all don't have the money. That's really the gist of the conversation here. Your wants is making you have to do things that you don't want to do. So stop wanting a lot of things and you won't have to do the things you have to do. But if you want to do something extreme or you want extreme change, you got to do something extreme to make it happen. But with all that, thank y'all for joining in. Thank y'all for chiming in. I might think I have a super interesting one next week, but that's still up for debate. But with all that said, please like, subscribe, share. Thank you for joining in. I'm going to give you about 28 minutes of your time back because I didn't take this a whole hour. Y'all have a good one. And I'll see you next week. Have a good one. Bye.